Hey guys, happy Friday. I want to do a quick market update for you. Just after last week, we got a lot of inflation news and whatnot. So I want to go over where we're at this week and what's influencing mortgage rates and how that's going to change over the next year or so. Here's where we're at today. This is a chart of the 30-year 5.5% coupon for mortgage-backed securities. So as these numbers go down here, mortgage rates go up. So we see that last week was pretty steady, although we did have a ton of volatility here. We actually opened, we came all the way down to this line here where we hit this level of resistance, and luckily we bounced back. But now these last 5 days or so, we've been trending downward again, meaning rates have been trending upward. But again, we hit this level of resistance here, and we see that today we're going back up. We have a lot of room to this upside, which is good. But what I really want to touch on is inflation data. A lot of folks know that over the last couple of years, there's been a ton of money being printed, which obviously as money supply goes up, inflation is going to go up. And the Fed has had a lot of policies out there to keep access to that money very easy, right? When the Fed funds rate is low, it's easier to access money, which increases the money supply. So what I want to point out is that inflation is a huge driver of rising interest rates. They tend to follow one another. Typically, the mortgage rates follow the inflation. So you can see here the inflation is this bottom line. So that's the headline consumer price index, really just inflation. And then this top line is the 30-year fixed rate mortgages. So we can see it tends to follow, right? But then after 2020, there was a portion where it does not follow, right? We see them cross over and the mortgage rates stay the same. This is what happens when the Fed does quantitative easing. So that's when they were buying a bunch of mortgage-backed securities, keeping the rates artificially low, even though we were seeing inflation creep up and up. Well, not creep, you can see it's a huge jump up. And as soon as they ended that, boom, we see mortgage rates start to follow once again. So with that in mind, the question is, when is inflation going to peak? When are we going to see this start to come down? Because as soon as we do, we know that rates are going to follow. So this is a quick snapshot of consumer price index. It's another version of CPI. It just strips out food and energy, which the Fed can't necessarily control. So this is what they're looking at when they're considering doing rate hikes and everything else. And how this is calculated, you see all of the white numbers on the right. These are all the last 12 months of readings of this core CPI. You add all these up and you get your 6.6%. So each month we replace and we drop off the previous month and it's replaced by a new one. So we see these four numbers over here from June, July, August, and September of last year. Those were replaced by these last four numbers on the right. And the 0.3, 0.2, 0.3, those are easy numbers to backfill with higher numbers, raising this inflation number here, which is what we've seen. But now as we creep into the later months of this year and into next year, we see a lot higher readings than the last 3 months, meaning it's going to be easier for us to report a lower reading, which will drop this 6.6, right? We're going to see that start to come down if we can come in with numbers lower than what we're seeing here. And that's going to have a significant impact on our mortgage rates too. So there's experts out there that are predicting that even within the year, we could see 5% again. I think that's maybe a little bit of a stretch, but I do think that within a year or so, it's definitely doable, especially considering that when the Fed hikes their Fed funds rate, it takes 4 or 5 or 6 months for that to actually be implemented and seen in the economy, which means that it'll be easier for us to replace these numbers being a little bit lower now that they're really starting to take hold. So keep that in mind. The long story short here is that, we're in a rough time right now, but there's better times to come, and things are going to change fairly quickly. I think, as you see here, as we get into March, April, May, the springtime of next year, if we're consistently reporting numbers lower than what's on the board here, we'll see rates start to come down. And I think it's going to turn out to be a hot spring market again. So let me know what you think. Let me know if this was helpful. Feel free to share it with any of your buyers to just give a little bit more insight into the market and what we're dealing with, what we're up against. And have a great weekend. Let me know if you need anything. How do I stop this recording?